Absolutely. Can you believe it? Warren Buffett's net worth has skyrocketed to a staggering $114.1 billion, up from last year's $100 billion, and we're only halfway through 2023. This seasoned investor always seems to have some impressive tricks up his sleeve, doesn't he? Indeed, we hear you loud and clear. In today's video, we're going to reveal the 3 assets that can help you say goodbye to financial worries, just like Warren Buffett did. Moreover, we'll provide valuable insights into his business strategies and techniques for selecting the right companies or investments. After you've hit that subscribe button to keep track of Stealth Wealth Society's latest videos, buckle up and get ready for some valuable information. Asset 1. Embrace the benefits of property investments and cash flow growth through real estate. Investing in real estate has long been a staple of Warren Buffett's investment philosophy. Real estate offers numerous benefits that can help you bid farewell to financial worries. One of the primary advantages of real estate investments is the potential for steady cash flow. Owning rental properties can provide you with a consistent stream of passive income, as tenants pay rent month after month. This cash flow can help you cover expenses, build savings, or reinvest in more properties, thereby compounding your wealth over time. Moreover, real estate tends to appreciate in value over the long term. While there might be fluctuations in the short run, historically, property prices have shown an upward trend, leading to potential capital gains for investors. This appreciation in value, along with the rental income, can significantly boost your net worth and financial stability. Additionally, real estate investments offer tax benefits. You can deduct various expenses related to your properties, such as mortgage interest, property taxes, and maintenance costs, from your taxable income, thereby potentially reducing your tax liability. Asset 2. Harness the power of stock market and entrepreneurship. Warren Buffett has also been a strong advocate of investing in businesses, and there are 2 primary ways to do so: through the stock market and by starting your own business. Investing in the stock market allows you to become a partial owner of some of the world's most prominent and successful companies. By carefully selecting stocks of businesses with strong fundamentals and competitive advantages, you can participate in their growth and success. The stock market has historically outperformed many other forms of investment over the long term, making it an essential component of Buffett's investment strategy. Furthermore, if you have an entrepreneurial spirit, starting your own business can be a path to financial success and independence. Building a successful company requires hard work, dedication, and careful planning, but it can be one of the most rewarding ways to secure your financial future. By creating a business that meets a genuine need or solves a problem, you can enjoy both personal and financial fulfillment. Investing in startup businesses can also be an exciting way to participate in innovation and potential high-growth ventures. However, this area requires caution and thorough due diligence, as startups carry a higher level of risk compared to established companies. Asset 3. Safeguard your wealth with gold. Warren Buffett has often emphasized the importance of protecting your wealth, and one of the ways he suggests doing this is by investing in gold. Gold has been regarded as a store of value for centuries, and it tends to retain its purchasing power over the long term, especially during times of economic uncertainty or inflation. Gold serves as a hedge against currency devaluation and market volatility. When traditional financial assets like stocks and bonds experience downturns, gold often moves in the opposite direction, acting as a safe haven for investors. This unique characteristic of gold makes it an essential part of a diversified investment portfolio. However, it's important to note that gold, like any other investment, should be approached with a balanced perspective. While it can provide stability to your portfolio, it doesn't generate cash flow or dividends like real estate or stocks. Therefore, it's best used as a complementary component alongside other productive assets. In conclusion, by incorporating these 3 asset classes, real estate, businesses, and gold, into your investment strategy, you can build a robust and diversified portfolio that may help you bid farewell to financial worries and pave the way toward a more secure financial future. Remember to approach each investment with careful research and consideration, and consult with financial professionals to make informed decisions aligned with your goals. Question: are you tired of being broke all of the time and living paycheck to paycheck? We have your back. Did you know that Stealth Wealth Society can provide you with financial insights in soothing that pain with our comprehensive personal finance course, priced at an affordable $97? Details are in the description below. Additionally, we have an enticing offer for you. Access the link provided in the description to get a complimentary copy of our personal finance ebook. It's a valuable resource to help you on your journey to mastering the art of wealth in stealth mode, and most likely, Buffett mode. Now that we have enumerated the 3 important assets to invest in, Warren Buffett identifies undervalued opportunities by posing critical questions to assess the correlation between a stock's quality and its price. It's important to note that these questions are just a concise overview of his 7-step investment approach, and he considers various other factors during his evaluation process. 1. Performance. At times, return on equity, ROE, is termed as the stockholder's return on investment, reflecting the rate at which shareholders generate income from their shares. Buffett consistently examines the ROE to assess a company's consistent performance compared to its industry peers. The ROE is calculated by dividing the net income by the shareholder's equity. Merely considering the ROE for the most recent year is insufficient. Investors should scrutinize the ROE over the past 5 to 10 years to analyze the company's historical performance thoroughly. 2. Debt. The debt-to-equity ratio, D to E, holds significant importance for Buffett in his evaluations. He prefers companies with a relatively low amount of debt, as it indicates that earnings growth is primarily driven by shareholders' equity rather than borrowed funds. The D to E ratio is derived by dividing the total liabilities by the shareholders' equity. Debt-to-equity ratio equals total liabilities divided by shareholders' equity. This ratio provides insights into the proportion of equity and debt utilized by the company to finance its assets. A higher D to E ratio signifies a greater reliance on debt rather than equity for financing. Such high debt levels can lead to unstable earnings and substantial interest expenses. To conduct a more rigorous analysis, some investors opt to consider only long-term debt instead of total liabilities in the calculation mentioned above. 3. Profit margins. The profitability of a company relies not solely on having a favorable profit margin, but also on the ability to consistently enhance it over time. The profit margin is determined by dividing the net income by the net sales of the company. To gain valuable insights into the company's historical profit margins, investors should examine data from at least the past 5 years. A high profit margin indicates that the company is executing its business operations effectively, generating substantial earnings relative to its sales. However, the real indicator of exceptional performance lies in increasing profit margins, which demonstrates that the management has been remarkably efficient in controlling expenses and achieving success in their strategic endeavors. By focusing on both the absolute level and the growth trajectory of the profit margin, investors can better gauge the company's financial health and its management's ability to drive sustainable profitability over the long term. Consistently expanding profit margins reflect a strong and competitive business model, which can be a promising sign for potential investors seeking reliable and flourishing companies to include in their portfolios. 4. Does the company have public ownership? Warren Buffett typically focuses on companies with a minimum track record of 10 years. Consequently, most technology companies that went public in the last decade wouldn't meet his investment criteria. He has openly admitted that he doesn't comprehend the inner workings of many modern technology firms and therefore only invests in businesses he fully comprehends. Value investing involves identifying companies that have proven their resilience over time and are currently undervalued. The significance of historical performance should not be underestimated. It serves as an indicator of a company's ability or lack thereof to enhance shareholder value. However, it's crucial to bear in mind that past stock performance doesn't guarantee future results. The role of a value investor is to assess how well a company can perform in the future, which is inherently challenging. Nevertheless, Buffett has demonstrated remarkable skill in this regard. Regarding public companies, it's important to note that the Securities and Exchange Commission, SEC, mandates regular submission of financial statements. These documents offer valuable insights into crucial company data, including current and past performance, to aid in making informed investment decisions. 5. Commodity reliance. At first glance, you might consider this question as an unconventional method to evaluate a company. However, for Buffett, it holds significant importance. He tends to avoid, though not always, companies whose products are indistinguishable from their competitors or those solely reliant on commodities like oil and gas. According to Buffett, if a company doesn't offer anything distinctive compared to other firms in the same industry, it lacks a differentiating factor. He refers to any such characteristic that is difficult to replicate as a company's economic moat or competitive advantage. The broader the moat, the more challenging it becomes for competitors to capture a significant market share. 6. Determining undervaluation. This is the crucial aspect of value investing. While finding companies that fulfill the other 5 criteria is challenging enough, the most difficult part lies in assessing whether they are undervalued, and this skill is paramount in Buffett's investment approach. To evaluate this, an investor must ascertain a company's intrinsic value through a comprehensive analysis of various business fundamentals, including earnings, revenues, and assets. The intrinsic value typically surpasses and is more intricate than the liquidation value, which represents the company's worth if it were to be dissolved and sold at present. The liquidation value does not encompass intangible assets such as the brand name's value, which is not explicitly stated in the financial statements. Once Buffett establishes the overall intrinsic value of the company, he then compares it with its current market capitalization, the present total worth or price of the company in the market. We really could not get enough lessons from this man. To satiate your curiosity even more, check out our next video on his investment strategies on how he became a billionaire. Click the link here to find out. We'll catch you on this next video, Stealthies.